and do a little bit of hard money lending. You know, over the years, kind of morphed into many areas. Using my own capital and my real estate investor capital, we do a number of hard money loans for other real estate agents, brokers, investors, flippers, you name it. So that's a little bit about myself. Happy to answer any questions and give you guys my insight of where I see things going here on forward. John, I think you're muted.
Sorry about that. John Casmon, I was going to say, you're up next. Tell us a little bit about what you do as an investor.
Yeah, absolutely. So John Casmon, I am actually based in Cincinnati, Ohio now. Used to live in Chicago, just moved last year. And we focus really on apartment syndication. So for those who are not as familiar with that, basically what we do is we pool resources together from investors and ourselves, and we take those funds and we go out and buy a larger property where we can afford to put in professional management, on-site property managers, on-site maintenance techs, and really try to focus on the investment side of the operations. So we've been doing that for the last 4 years or so. I really got into multifamily, starting with smaller multifamily, started with a duplex and kind of house hacked that and worked up to a 3-unit in the, in Avondale, got an 8-unit property out there in Hermosa. And from there, I just, was saving our own money, investing, and realized that I was on a very slow trek. It was a very slow pace to build the portfolio and started to get interested in finding ways to partner with other people to kind of accelerate that trajectory. We also, we host a lot of events. John mentioned the Midwest Summit, which we've got coming out here June or July 25th to 26th. And then we also host the Chicago Multifamily Club. So we unfortunately have been having to meet in a very similar fashion with Zoom, but hopefully we can get back to doing those in-person meetings as well.
Awesome. Thanks so much for giving us your kind of intro there. And Andrew, last but not least, tell us a little bit about what you do as an investor today.
Yeah, so primarily as a real estate investor, I look to buy multifamily apartments that are, 6 to 12 units, probably, upwards of 25 units in a building. I used to own way bigger buildings, but that requires a whole separate business model, and I'm just not teed up for that right now. So in addition, I opportunistically buy smaller buildings, 2 flats, single family homes, been flipping those for a little while now. Vicky knows that. Yeah, that's, pretty much my, real estate investing situation right now.
That's awesome.
Yeah.
Appreciate it, guys. Second question I was going to go through for everybody was, what changed for your investing during the last recession of 2008? Were you able to take advantage of it? Did it cause you to take losses in your investing? So, and this is kind of where I think a lot of our guests here are interested in hearing from your experience. What did you do last recession? Or if you've been through multiple recessions, feel free to speak, in depth about just recessions in general. So Tony, I'll let you get started first.
Thanks, John. This will be my 3rd recession professionally that I've gone through. Early 2000, I was a budding real estate investor. It really didn't have a direct effect on me, except that I noticed people were getting out of the stock market and buying multifamily properties. That actually was really the start of my career. Where it really kind of took off was after that 2000 recession. Multifamily in real estate as a class became much more popular. Going into 2008, I'm a broker as well. I primarily sell my own properties or deal with my own agents. I have a few agents that work for me. And so I got a good feel, good pulse for the market. In the old days, the guys in the stock market used to be able to read the ticker in the old days, they used to call it, because they would get a feel for the stock market. Well, I've got a real feel for the housing market, the multifamily market. Going in 2005, 6, 7, I saw the writing on the walls. People were paying way too much for properties. I sold one property to a gentleman who borrowed money off of his house to buy a 9-flat in Berwyn. And there was just something going on that I was noticing that the writing was on the wall. Luckily, during those times, I was selling off my buildings. Kind of because my business actually was slowing down as far as being a broker, and I was transitioning to more of a real estate investor to fund my lifestyle. I was selling off my buildings. So 2007 and 8 hit, I was in great shape. I went in with just 6 buildings. They lost plenty of value in 2008, but I doubled down, and I went out there and I became an REO broker for PNC Bank, and that really, the trajectory from there was just phenomenal. Getting the insight from how the commercial REOs was working with PNC, had access to a lot of REOs, had access to a lot of notes, started buying notes, started buying distressed property, started raising capital. As I'm going along, I was grabbing everything I could, but I was undercapitalized, and I started raising capital, and really had a good 6 or 7 year run of just buying properties. And I said to myself, what's going to happen is I'm going to look back on these times and be amazed how I ever was able to buy some of these houses and properties so inexpensively. Quick story, one of the agents I used to work with was 90-something years old, and he was always telling the story of how he would sell houses for $39,000 in Berwyn and Cicero Market. And lo and behold, we were able to buy those same brick bungalows for $39,000, which is what they were selling for in the 1940s and 50s and 60s. So in any event, went into 2008 in great shape, came out of it in even better shape, bought a lot of properties, probably in excess of 75 foreclosures on houses and in excess of 50 apartment buildings. So that's where I came into 2008 till now. The last 2 or 3 years, I'll tell you something, I'd rather be lucky than smart, right? The last 2 or 3 years, I've really noticed the buyers of the apartment buildings were a less sophisticated lot. And we'll talk more about it later, where I think the market's going to go. But the market, the last 2 or 3 years, we're getting less and less sophisticated. I always sold buildings throughout the 2008 to 2019, okay? And a lot of them were going to younger guys, investors, people who raise money, private equity firms. Just the last couple of years, I noticed I was selling buildings to people who really shouldn't have been buying buildings, borrowing money or had other businesses. So the writing was on the wall. Matter of fact, I sold a 6-flat in Berwyn recently, the 5th time that I sold this building, 5th time. And I sold it in 2007 for $695. We just sold it in March of this year, March 3rd, I believe, for $600,000. Just to give you an idea of where things can how trends can go. And I knew that was going to be the top. I didn't know about Corona, but I knew that this lady buying that building, hopefully she's not on this call, was her first building, and she actually offered quite a bit more, and it did not appraise out, and we sold it for $600,000. So I breathed a sigh of relief that I sold 9 of my buildings in 2019, and I raised a lot of cash getting ready for an eventual downturn. It just so happens that this Corona is what pricked the bubble here.
Awesome. That was really cool. John Casmon, so what changed for you and for your investing during the last recession? And, what did you do to take advantage of it?
Yeah, so right at the last recession, I actually hadn't started investing yet. I was getting ready to pull the trigger on my first deal. And to give you some context, at that time, I was actually in Detroit working for General Motors. So to paint the picture, you can imagine 2008, I'm sitting in my office and getting calls from leadership to come up and understand my budgets and things like that. And at the same time, I have an offer out on a property. So what ended up happening is, obviously, we ended up realizing our financials were, going down the toilet. And before we realized this was really an economy issue, we thought it was just a company issue. So this is back in May of 2008. As it became clear that this was really a larger issue affecting the economy and not just General Motors, not just Detroit, I was uncomfortable pulling the trigger on deals at that time. So that actually sparked my move to Chicago a couple of years later, because I wanted to invest in real estate and I was not comfortable investing in the Detroit market. And we bought our first property in Chicago in North Center right around 2011, 2012, as prices were starting to go up on the upswing there. What I'll say, though, is working on the corporate side, and kind of what I noticed, being in an environment where we saw values kind of depreciating and trying to really figure out what was going on. I think one of the biggest things and biggest lessons that I learned was to really focus on kind of the long-term aspects of it. a lot of people are trying to time the market. A lot of people are trying to figure out how do you, buy at the right time, sell at the right time. As Anthony mentioned, it's better to be lucky, but lucky is also not a business plan. So, part of what you have to do is try to make sure we're being smart and intelligent with our strategies in general. If you're a buy and hold investor, if it makes sense to sell, then sell. If it makes sense to continue to hold, then continue to hold. So I think that's really the biggest thing, is not to try to get too greedy in this situation. If you can be opportunistic, absolutely be opportunistic, but let's also not try to time the market and try to think we're better than all the other experts out there.
Right. Yeah.
You're muted, John.
Thanks. As a quick follow-up question, John, for you, I know that as a syndicator, you've bought several deals. Did you guys buy anything in the last year or two, or did you kind of put, the brakes on as you saw we were getting towards the end?
Really slowed down. We slowed down our acquisitions. We are starting to see some deals now. And I'll say for me, it comes down to, and I think Anthony hit on this too, there are a lot of other groups who are buying, and they are, paying a lot more money than we're comfortable paying right now. So we've kind of shifted our gears. We've really stopped going with brokers, and we've really started focusing. I mean, no offense. We still talk to brokers. We still look for deals from brokers, but the reality is a deal that goes out to hundreds of people, it's not likely that we're going to be able to go in and win that, right? We're not going to pay more than other people just because we can. For context, there was a deal I was looking at just about 3 months ago. So right before Corona really hit, and we got outbid by $500,000 on an $8 million deal. And that was in the best and final, and it was like, how can someone come in and invest another $500,000, 45-day closing period, no contingency, $100,000 cash, hard day one. I mean, it was just things that we just looked at as like, yeah, all right, well, tell them good luck. And we saw a lot more of that, right? Groups getting really, really competitive. And I think the reality is what we have to understand at the larger macro level scale is some of these groups, there's institutional money, and there's only so many places they can park that capital. And when you're talking about global investors, you're talking about Chinese money, Australia money, you're talking about French money, Canadian money. Those groups don't care. I mean, they see New York City as cheap. And what ends up happening is it pushes everything else down. So the New York buyers, the California buyers, they now look at, Chicago and say, third largest city, I'm gonna invest in Chicago, sight unseen, it's a great place to be. So that starts to happen. It has a trickle down impact on the rest of us retail investors, whether you're pulling resources together from friends and family or whether you are using your own money. Ultimately, it's still going to impact most of us. But I do think that you're seeing the market kind of self-correcting a little bit. And it'll be interesting to see, and I know we'll talk about this a little later, but it'll be interesting to see how those groups and how the market in general reacts to this resetting here over the next few months.
Thanks for that, John. Wanted to give Andrew a chance now. Andrew, what changed for your investing during the last recession of 2008? Were you able to take advantage of it? Did it cause you to take losses in your investing? Tell us a little bit about how it affected you.
So in order to answer that question, I need to go back to the 2001 when I started investing. And so I started with this 24-unit apartment building, and then we bought like a 56, then we bought like a 9 unit, and da-da-da-da-da. But all the while, we were cross-collateralizing. So I was levering up, and then using this equity after we rehab this to buy this building and so forth and so on. So then we ended up selling a big portion of that portfolio, not getting into even bigger properties. Okay. And so in 2008, when that happened, we had sold one of our bigger properties, which was great. We're trying to get out of a few of them, but not all of them. And what happened was we owned this 152-unit apartment building in Toledo. Okay. And it was, we bought it with equity. We had stuff there. But PNC Bank comes right after the market goes down and the whole thing's going around. And they're like, well, we need more equity from you. We need $500,000 more equity. And we're like, well, we don't have it. We don't have, we just, no, the whole market just crashed. And like nobody has money right now. So how could you ask me for $500,000 more? We were like fine in our payments. We weren't like behind on anything. The debt coverage ratio was fine, and but they had changed their rules because the federal government had made them change their rules. house, right? We were like, no, we're not doing it. So what changed for me is debt and banks in general. So right now I try to operate with as little debt as possible, because even though it's not the best way and you can't really scale that way, I just feel like when times are bad, the banks are your least amount of friends. They're not your friends. And in fact, I just saw it just the last couple of weeks during this COVID, when they were saying, oh, well, everybody's losing their jobs. And then JP Morgan Chase comes out and they're like, oh, well, we're tightening our lending standards. So exactly when you need them is exactly when they're not there. And they're ready to lend you money if you don't need it, right? Like the most well-capitalized guys. Yeah, we're open for business. This is great. But like normally it's not going to be that way. So that's how it's changed for me, is I try to keep as minimal amount of debt, if I even need to, on anything, right? And if it is, it's got to be short-term debt, like, you know, the cleaning people are here in my office, but yeah, so it's got to be short-term debt. So that's what's changed for me, and so I'm just a little leery of lenders in general, especially like big, you know, PNCs and Chase and so forth and so on. But that's not always possible, and certainly you're going to need that, especially, John, you're doing $8 million deals, so you're not going to, you know, you're not going to fund that 100% with equity. But I do like just keeping things lighter on the debt side. So that's what's really changed for me from the last recession, coming out of the first recession in 2001, and then obviously into this. So because ultimately here's what happens, and it's the trickle down is this, okay? The people who are our renters are generally the lower end of the scale in terms of the pay. So those guys are the first guys to lose their jobs all the time, every time. And so when they stop paying you, you then can't pay the bank. And then, you know, right now everybody's like, oh, you know, really lovey-dovey, like, well, we'll defer your payment and we'll do this, and we'll, you know, the government's stepping in to do that. But in a typical recession that isn't a pandemic, it's not that way, right? And as we all know, the recessions, it's cyclical, right? So it's going to happen, whether or not, obviously it's happening now with this, but it's, you know, if it wasn't for this, then maybe in a couple of years there would have been another recession, you know, just from some other, just general business cycle. But so that's what happens. The people can't pay you, you can't pay the lender, and then it all goes south from there. So I don't like it.
I wanted to ask a follow-up to kind of get to like some of your strategy. What ways were you able to capitalize after the last recession? Because I know that you've done some flips and you've bought buildings and things. Like, what ways did you capitalize on it?
Yeah, well, obviously, I mean, there's, you know, just like Tony, I mean, there's a lot of blood in the streets. So if you got some capital, you know, you're the guy, you're standing on the guy's grave, and he's got to sell this building because he's got to get out of it. Or you have relationships with banks, and you know, they got to sell it. They're not in the business of owning real estate. They want to lend on real estate, and they want to make their spread between, you know, what they borrow money from and lend money to. But they're not in the business of owning real estate. So you can get good deals coming out of a recession because there's guys who are pretty, and then they got to sell. The bank either forces them to sell, or you know, have relationships with the banks and whatever, and they negotiate some sort of friendly deal. So I bought maybe, God, I'm going to call it 200, maybe 250 units coming out of 2008-9 from the banks. And all the banks were trying to do was kick the can down the road. They were like, oh, we'll give you a mortgage. And I'm like, yeah, but I don't want a big mortgage. I'll take a little mortgage from you, but the price of this property has to go way down. You have to write that off, because I'm not buying it for whatever this guy was going to foreclose on, just because that you got to get it off your books and kick the can down the road. So that's what, yeah, I probably bought 250 units that way back in 2009, 10, something like that. It's a decade ago, so I can hardly remember.
That's awesome. So we're going to go back to the beginning now of the order here. Tony, next question was, what steps are you taking to protect your current investments and to take advantage of the shifting market with this current recession?
Well, good question. And right now I have a mixture of multifamilies as well as some commercial properties. I've diversified over the years. I've tried to get away from the single-family homes in 2 and 3 flats, and have more of a mixture of multifamily as well as commercial. I've worked with the tenants to apply for PPP loans where appropriate. I have a couple of restaurants, a car wash, and some other automotive-related businesses. right now, knock on wood, they're all doing okay. Most of them got their PPP loans. Most of them are considered essential businesses. One of my restaurants is closed down. I don't think they're going to reopen, but the other ones are doing well enough. So been working with the tenants, both the commercial tenants and the multifamily tenants, helping them get any and all their stimulus checks. I was checking my account today, and I got 2 tenants that paid $1,200 today. And I can only imagine that that was from their stimulus money. So the tenants who haven't been paying, we've been working with them, trying to encourage them. I use a management company to manage most of my multifamilies, and they have easy access through the website to some of the resources for the tenants. What I really did, right now it's too late to do anything else other than just maintain what you have and keep your tenants happy, watch your expenses. The time to do things was 6 months ago going into this, which is what I did, which was refinance a number of my buildings. So I have long-term debt on the properties. I don't have any loans coming due in the next 3 or 4 years, so I feel good about that. Banks are still lending, refinancing a couple of buildings as we speak. Rates are not quite as low as I would have thought, but they're still attractive rates. So that's really where it's at now. I think it's going to be telling. Right now everyone's in a wait and see pattern. I don't think we're going to have a true sense of what's going on for another probably 60 to 90 days, maybe more. Once the expanded unemployment benefits run out, then it's going to be a true test.
Yeah.
I believe it was Andrew that mentioned, when this first happened, most of my tenants are lower socioeconomic group. I was really panicked, but they've come through. I've only lost about 5% of my rents for April. And May's trending probably right now about a 7%. We'll see how it ends, but probably about a 7% decrease in May. And I'm really anxious for August 1st. So now it's too late to prepare anything, but just maintain what you have and just help your tenants along.
Yeah.
So your thought process at this point is that we haven't really seen the real results of this recession yet. It's been band-aided.
It's been band-aid over. One of the gentlemen mentioned about the stock market. People watch the stock market. It's an instant, game clock, if you will, or a scoreboard. And there's no correlation between the stock market and what's going on in the street. I've been out and about recently, and I've noticed traffic is increasing. People are out and about. I was in Northwest Indiana. You would think nothing's going on over there. But then you hear about 40 million people out of work. Most of those people are renters. So we'll see. Right now they seem flush, and but we'll just see if the government programs continue on or they end.
Awesome. So same question. We'll bounce it over to John Casmon. What steps are you taking to protect your current investments, and then also to take advantage of the shifting market?
Yeah, I think for us, because of the nature of our business with larger scale apartment buildings and with syndication, we are focusing on basically a slow flip, if you will, right? So it's kind of a house hack / slow flip. So we're talking about hundreds of units where we're going in with a business plan to remodel the units, slowly increase rents upon unit turns, adding amenities, increasing rent annually on a kind of a schedule. So for us, one of the big things is we usually raise CapEx, capital expenditures, for the renovations that we're planning on doing. One of the biggest adjustments we made right away was we kind of stopped on almost all instances. We've stopped doing renovations. The reason for that is simply we want to be in a cash position. So if residents are unable to pay bills, if we're in a situation where we see a 10, 15% drop in rent collection, we want to make sure we have some more reserves available. So there's nothing we can do with the reserves we had initially coming into the deal, but we have a bucket of money over there for renovations that we can hold off on. The other reason for that is, if we are renovating a unit, and let's say we're spending $4,000 or $5,000 a unit, and we're expecting to see a $150 rent increase for spending that money. Well, if the market drops and we no longer can get that $150 rent increase, it doesn't make sense for us to invest that money into renovating the unit at this time. So we kind of pause renovations until we can get a better sense of where the market is netting out and how things are holding there. One of the big things we did was we talked to our lenders, making sure that we understand where our lenders are at. Are they going to start putting more pressure on? We were really concerned with kind of the different loans that came out and the forbearance. We did not apply for that. You know, as as Andrew kind of alluded to, I'm not necessarily a big trusting person when it comes to the banks, and I think signing a document that says, you know, I'm having a hard time paying you, I don't see how that's going to benefit us in the long run. At some point, they're probably going to use that against us. So we just felt it didn't make sense to go down that route and just kind of hold off. We could pay our bills. We actually didn't see very much of a drop in the rent collections. I agree with the rest of the guys that, you know, I think the real test is going to be a few months from now. I'm hopeful that with elections in November, that current elected officials will recognize they probably want to keep their jobs, and having people hungry or trying to figure out how in the world they're going to pay their bills come election time is probably not the best way to win an election. So I imagine that they will do something to try to keep people going through the end of the year. But one of the biggest things, like I said, outside of just slowing down on renovations and making sure we have more capital sitting aside, the other thing we're trying to do is just really think about how we can take advantage of these opportunities on future deals. The loans right now on the large commercial things, the Fannie and Freddie products are fairly cheap. They're offering 3.25% financing, 3.5% financing as far as the interest rates, but they are asking you to have a year's worth of interest set aside. So you're now looking at, you know, hundreds of thousands of dollars potentially in interest that is just sitting in an account, because they want to make sure that you can pay them even if you can't pay anything else. So those are some of the things that they've changed on their lending requirements. So it's definitely important if you are looking at something larger, especially in that $1 million and up range. If you're looking to get a Fannie or Freddie product, you need to really understand what their new requirements are and make sure that the deal still pencils out if you have to sit money in a bucket for a year.
Awesome. So I guess the takeaway I got from that is pausing renovations until you have, you know, so your business plan is validated that the rents will still be rising, or, you know, you'll still get that rent bump. So thanks for giving us that little nugget there. That was awesome. I'll bounce the ball over to Andrew now. Andrew, what steps are you taking to protect your current investments and also to take advantage?
Yeah, so just like Tony said, the thing, you can't really adjust mid-course right now. You had to do this. You had to set things up prior to this even being a thought in anybody's head or whatever coming out of China. But so what I do just to maintain the safest rent collections stream is I have a combo of Section 8 renters and then also market tenants. So I can get higher rents from the market tenant, but the safety of the Section 8 tenants, even though there's a major trade-off for that, because Section 8 tenants require more inspections. It's sometimes hard to deal with the red tape of getting the rents and the people and the they're not as plentiful necessarily if you don't have a source for them as regular market rate tenants, but you've got that safety net there. So you can't do anything now because, you know, I mean, there's certainly people moving, but it's harder for people, and people don't feel safe right now moving that much, right? I mean, you might get a 1 off or 2 off, whatever, but if you have 80 units to lease up, you ain't getting that right now. So, you know, so that's what I've done. But again, the same thing, I go back to it, you know, just have as little debt as possible, if possible, right? Because, and then certainly in the low rates, as Tony said, you know, several months ago, or even right now, you can refinance. There's banks are open for business. They're starving for business, to be honest. They got the PPP loans, and there's, you know, a bunch of stuff that they get out of that. But at the end of the day, like, there's less activities. I just saw this headline yesterday that commercial transactions in Chicago were like down 70% in April, or 62% or something like that. So, I mean, these transactions aren't happening because nobody's going to look at the buildings because nobody can, you know, whatever. So, or nobody wants to. So, you know, that might change starting, you know, in June again when things are opening them back up a little bit, but, you know, it's still going to take a little bit more time. And then there was also the lenders that didn't want to, you know, they pulled the deals right off the table. Like, they were like, oh, well, we were going to close, but now this happened and the world's changed, so we're holding off, right? So there's that. So, but now, there's guys that are still lending, but, you know, I think that it's like everything else. Now it's just a lot harder. It's going to take a little bit longer, everything. So, you know, in the future, I don't know, this coming out of this, and this will lead right into the next question, you know, and stop my thing there and kind of leave your next question, which is, do you have any advice? I think is your next question.
Just jump into it. No, go
Yeah,
ahead.
right. So the advice.
Do you have any advice for listeners?
My advice here, and I want to hear Tony's take on this since he's the tea leaf reader, is, just be patient here, because like, again, all these tenants, they're all being propped up by the Fed and the government, the IRS sending them checks and so forth and so on. And when that's gone, it might get extended. But right now it's going to end at the end of July. So until those times happen, we don't know what the real price discovery is, because who knows if these people are collecting rent. Maybe the guy can make his mortgage with these people getting the $600 a month, $600 a week, but maybe he can't, right? Once it all's gone, and then guess what? Then look out below. But the banks are in better shape, and the banks have a better system now because they were in the 2008, 2009. They can take back buildings quicker, and they got a better process for that. And the banks are just in better shape, also way better shape. So they're not going to be as it's not going to be as bad. It certainly won't go down as bad. But with all these people unemployed, who knows? And how many jobs are coming back? The restaurant, as Tony was saying, the restaurant, he's got one tenant at the restaurant might come back. My brother-in-law owns bars. He's got bartenders and stuff like this. He's like, these people, like, why would they want to come back when I can only open up at 25% capacity? So now I have to take a 75% pay cut on tips because you guys want to open? No, I'm not doing it. So it's like, so that's my advice, is just be patient. What else did I hear? Yeah, 10% unemployment for a long time, which is, 2 to 3 times what it has been over the last couple of years, right? It's been 5 to 3% unemployment. Now we're at 25, but it might go to 30, and it could go back down to 10 eventually, but for a long term. And how do we operate at 10% unemployment? It was 10% unemployment in 2008. And that was pretty bad. So that's my advice.
Awesome.
Be patient.
So yeah, the same advice, then we'll jump over to Tony. Do you have any advice for the listeners in your current niche? And I was going to say too, this has been a little more multifamily heavy maybe than I thought, which is fine. I am a multifamily guy, but also I know, Tony, you've done a lot of flipping, so you can reference flippers too.
Sure, I'll reference everything. Well, I'll tell you, Andrew, you hit it right in the head. I wrote down some notes earlier, and I said we need more time and more information for price discovery. I've been presented a number of deals in the last 2 months, some that seem pretty attractive, and I would have jumped on them, 6 months ago. And how can you value something without knowing, how it's going to look on the other side of this thing? So I think it's too early to say definitively what's going to happen. When this first started, I thought that I was going to feast again on single families. We'll keep it to the single families. I was thinking we're going to feast again on single families and notes and everything else. I'll tell you what is going to be different about this recession than the last one is going into this one is the amount of money that's floating around out there. And just last week, I had 2 guys call me up, each raised in excess of $10 million to buy distressed property. People know that I'm a good bird dog when it comes to finding distressed deals. And I thought it was pretty telling that these 2 guys, independent of each other, they don't know each other, each raised in excess of $10 million to buy deals. That's just one example. You can read the news for bigger companies who've raised billions to buy deals. So we'll see what happens. Now let me focus on the single family market, which may be of interest to everybody here. Made quite a business buying properties at judicial auctions. There hasn't been a judicial auction for going on 2 months now. How's it going to look when it comes back? Is it going to be depressing prices? Could be. Is there going to be a real dislocation in the values because no one knows what you can pay for a property? Possibly. I think also there might be some government intervention. They don't make it easy on investors to begin with buying properties at the judicial auctions with all the rights for the tenants and the old owners. They can make that worse and more difficult for us as investors. So I think, right now you got to be in a wait and see mode until we have some more information. So I see keep some dry powder, talk to your investors, work on raising capital. The bottom line is you got to find deals. If you can find good deals, then you can find the money.
Still on mute, John.
Muted, John.
Rats. One more follow-up question for Tony before I jump to John. Thanks, guys. I know you've done some wholesaling as well. What advice would you have for people who are maybe trying to get started in wholesaling? Because we have some of those people here too.
Oh, I'll tell you, I didn't start off as a wholesaler. I started off kind of backwards. I was more of an investor, buying the properties, fixing them up, going through all the permitting with the different villages. And boy, I can never do that again. I'll tell you, I've rehabbed so many houses and dealing with all these villages. I became a wholesaler more recently. And gosh, a couple of stories, if I could indulge you on wholesaling. If you follow everyone else looking through the MLS, you'll never find good deals. Reach out to everyone that you know, insurance agents, lawyers, you name it. My insurance agent last year called me up, had a client of his who wanted to give a property away in the city of Chicago. And for 2 weeks, I didn't even go bother looking at it because it's free. What good is it for me? And finally, I go look at it. It's a great property. He paid $50,000 for it in 2011. He literally deeded it to me for a few $1,000, and I was able to wholesale that right away. So you never know where you're going to find a deal. I've wholesaled a lot of properties that I bought at the auctions because I'd rather make a quick nickel than a slow dime and not have to deal with all the village troubles and dealing with the tenants and dealing with the old owners of these properties. So you need to have a group of investors who you can sell these properties to. In my case, oftentimes I would finance the investor as well. So I'd get a fee for wholesaling it to them. Then I'd get a fee on the financing aspect of it. So I really like doing that.
I thought wholesaling is supposed to be how you get started when you have no money, no experience, and all you have to do is find a deal. You just made it sound a lot harder than everything else I've ever done.
Well, I'll tell you, like I said, I came into it backwards. I thought the same thing initially, but I find wholesaling right now, if you have access to the product, I mean, it's really about product. Bird dog sometimes has a negative connotation to it, and it really shouldn't. I'm a bird dog for 25 years, and you can bird dog single family homes, you can bird dog commercial property. I bird dogged the biggest deal ever. I bird dogged was a couple years ago in the city on a commercial building, and was able to bird dog that property. Went out there, found investors, was able to buy it with a partnership group that I put together, no money out of my pocket. It was the biggest deal I ever did. And it was just from finding a deal.
Love it. Cool. I'm going to bounce this over then to John Casmon. I almost forgot the original question. Sorry. Do you have any advice for our listeners who either invest in your current niche or they aspire to be a syndicator?
Yeah, I mean, I'll take a little bit of what Anthony said. I think the biggest thing here is you need to really build your network. Right now there's going to be opportunities. I think we all sense that there are going to be opportunities in the near future, but you have to have the network to take advantage of them. So if you are looking to raise capital for deals, you need to start connecting with potential investors. You need to start talking to them. You need to start educating them on, what to look for. They're going to have questions, right? The same questions we're going through. These are similar questions you can expect from investors. Why should they pull money out of the stock market? And as people are watching their stock portfolios drop, that's when they're going to get really interested in preservation and saving some of that equity. So now is the time to start having some of those conversations with investors. As far as deals and opportunities, one of the things that makes multifamily, at least a large scale multifamily, very appealing is the fact that you have kind of these checks and balances. If you have a 100-unit complex, in a situation where, some folks may lose their job, in theory, you should still be in a situation where most of your tenants can pay their bills and you can cover most of your expenses, even if you see a 10% drop in vacancy or a 10% drop in occupancy. So part of what you will need to do is really be more conservative on the way you look at deals, the way you underwrite deals. We've talked about what the lenders are doing right now. But for me, one of the things we're doing is basically doubling up our bad debt, doubling up our concessions, doubling up our economic vacancy. So we're looking at it saying, hey, look, maybe in the past we would have had total vacancy or economic vacancy of 10%. What does this deal look like if that goes to 20? And it's not saying it'd be like that for the entire year, but we want to understand, can we operate? Is this deal still going to pencil? Is it still going to work? So really trying to stress test these deals to make sure we understand where they're strong and where they have some weaknesses. The other thing that is trying to make sure that we're doing deals where we don't have to exit within the next 24 to 36 months. You know, I don't think any of us really have a clear sense of what the market's going to be in the next couple of years. And if you don't have to sell during that window, you want to be in a situation where you've got flexibility. So if the market is strong at that point, great, you can sell. If it's not and you need a little bit more time to recover, then you get a little bit of a longer loan in place so you can sell. Right now, we're actually looking at 10 and 12-year loans on some of our commercial deals, just to make sure we have that flexibility and get us through 2030. If we absolutely needed to hold a property, that's the way we want to, you know, have some flexibility there. So just really trying to make sure we think through a lot of the potential issues and things that could jeopardize the deal, and making sure that we've got some answers in case we need to do that. I'll use the example Andrew gave before from 2008. You know, if we were in a situation and the bank said, hey, you need to have more equity, we know that we may need to do a capital call with investors. We kind of have, you know, secondary investors kind of set up where if we ran into some sort of situation like that, if we needed to go out and get some more capital, we could do that. We're also not planning on any refinances right now. So if we could do a refinance in a year, great, but we're not banking on it. It's not part of the business plan. So really just making sure that we're not putting ourselves in a situation where you need refinance or you need something in the market to be valued at a certain point. We only really care about the value on 2 days, and that's the day we buy it and the day we sell it. Other than that, the only thing we're really concerned about is cash flow, which is a serious thing that we're worried about right now. So everything else we're doing right now is focusing on optimizing cash flow.
Awesome. So we've reached the end of the pre-scheduled questions. So now what I want to do is open it up to the audience to ask any of these three gentlemen questions. So I will open it up.
I would love to hear what happened after they asked for the $500,000. How does that story end?
Well, it ends with us being forced to sell the building because they were like, we need all this equity. And there was actually, it was a crazy situation where there was a lawsuit against us because a woman had died in the building and they were suing us because they were saying that we were negligent, when in fact this woman who died, it was her boyfriend who killed her, not even on the property, but they ran out of the building across the street to a public park. And he killed her. It was crazy. So this was all going down at the same time. So they were on that. So and the elevators needed like $350,000 because it was a 13-story building, 14-story. So we were like, you know what, let's just sell this thing. So we ended up selling it. We got whatever our mortgage was for. So I think we lost our entire equity position in the whole thing, which sucked. I think that was like $500,000, maybe $600,000, something like that. It was a lot of money. So, but we had to do it. Otherwise it was going to be no bueno. No good for us. So that's how it ends.
Andrew, how is it that they were able to ask you for additional equity when there was already like a note recorded? How does that work?
I don't, that's part of it. We were like, why are you, these were the terms when you were, when we signed this thing up, and we can't give this to you now, but they were forcing us to do it. I don't know. I don't know what the rules were. I was never really a big fan of PNC, but that really solidified it for me that it was not a good deal.
I had a similar experience during that time frame. If you go through all 40 pages of your loan document, you can find the place where it says, if the feds change all the rules for the banks, we can change all the rules for you.
I think that's essentially what it was, right? They were being forced by the federal government and the Treasury Department to recapitalize at a certain level, for whatever. And so we were the trickle down, right? So they were like asking us for the money and we didn't have it. We're like, no, we don't have it. So eventually that's what happened. We just sold the building. So not a happy ending.
I wish
that's how you learn. I'm sorry, say that one more time.
I said, I wish I knew you back then when I was working with PNC. They had a shoot first, ask questions later attitude back then, and they
For
were just
sure.
selling things off like crazy.
Yeah. Well, they forced us to sell it, but I mean, technically we sold it. They didn't take it back and then sell it.
Right. But
Yeah.
notes and short sales, you name
Right.
it.
Oh yeah, it was essentially that. So it was not a fun period, 2008, 9. But I'll tell you, even if even guys who own a single family house right now are trying to flip it, and you might not be able to for several months. Maybe there's no buyers, right? Maybe you won't be able to do that. You learn from your failures. You don't learn from success. You learn from your failures. So that's one of my kind of mantras in life. That you know what, had I not learned that these banks were these kind of people back in 2008, and guess what? The 75 units or 65 units that I got right now, maybe I'd have debt on them, and maybe these guys wouldn't pay me, and then I might be in the same situation again. So, it's kind of like something like that.
John,
Andrew,
you get my message?
I didn't get any message.
I have a question for Andrew.
Yeah.
You mentioned your preference for short-term debt if you're going to utilize leverage rather than long-term debt. And I'm wondering if you could explain that, and it kind of goes counter to what I see as risk as a borrower.
Well, what I meant by that is like, say you're flipping something and you don't have all of the money, right? You don't have all the money, but you know that it's only going to take $100,000 to rehab this house, and you can then sell that house in a year, or after you're done with this rehab. You don't want to lever up the full amount, but you can get 6-month debt, right? Or 9-month debt or 12-month debt, something like that. Obviously, there's going to be hard money guys that are going to give it to you. Maybe you can get a home equity loan if there's something like that you need, but which are 2 to 5 year type of deals. But essentially, you don't need to go out and go get like a mortgage, a 30-year mortgage on the thing, which, if you wanted to, but the banks aren't going to lend you on a rehab project like that. So that's what I was really kind of going for was, on smaller, say fix and flips, you're fixing a single family house or whatever suburb or whatever part of the city that you're doing, maybe you can't fund all of the rehab yourself, so you can go borrow some of it, but you could borrow it in a short-term fashion, right? And even if you can't finish it with that kind of money, you could still sell it. It's probably make some sort of money on it, even unfinished, possibly.
Okay, thanks.
That's my thought.
All right.
I have a question for John Casmon. So when you decided to make the jump between full-time investment and syndication, what do you think are some of the biggest reasons or things that you did that made you successful in that jump?
Great question. There were a couple of things. I think first and foremost, aligning myself with the right people, right? So I spent a lot of time educating myself. I brought on a mentor to just help me learn the ropes, and you can do that in a formal way. You can do that informally, but I would say that it definitely helps to have someone that you can talk to who's actually been there and done it and can help guide you through that process. And then I would say too, like the mindset is really important. And I don't mean that from a philosophical energy type of situation. What I mean is you have to understand the value you're creating for other people. If you go into it saying, all right, I need to raise $500,000 for this deal I'm trying to do, then you're coming at it from your perspective of what you need. And that's the energy you're going to put out there versus if you put out the energy of serving other people and creating value for them. How do I help people get some passive income, pay less in taxes, and diversify their portfolio? If you come to them with that kind of energy, it's going to be much easier for you to have a conversation with people. So for me, at least, especially when you talk about friends and family who most people are going to raise money from, they don't care about the real estate. So me talking to you about a 10% cash on cash return and it's in this great neighborhood and all of that, they were like, dude, I don't care. It's over the head. But when I could talk to them about what they were interested in, their goals, and how what I was doing could benefit them in that capacity, that's when the light bulb went off. So I would just say really thinking about what you're doing, how you're doing it, and positioning it. And I'll say one other thing too that's kind of interesting, because for me, I made a transition to running a business versus just being an investor. And the reason I say that is, as an investor, you can sit and wait and cherry pick until the deal is right for you, right? And I think everybody on this call right now, if you waited out 6 months, 12 months, 18 months until you can buy at the absolute bottom, you should do that as an investor. But if you have a business, you can't stop your business just because the market has changed. And there are people who I feel need our services now. There are people who absolutely, are looking for some of the benefits now. So we have to go out there and find a product, right? We can't just wait until we can buy for pennies on the dollar. We have to keep doing deals now. So we have to be conservative. We have to be smart about it. But we also need to find ways to continue to grow.
So John, this is JR. How you doing? To follow up with that, I agree with you. You got to be smart about looking at deals, because my job as a broker / investor too is to tell my clients, that, look, some of them are scared, some of them are aggressive. You got to find that medium, right? But like, what does that look like, right? Like, I know it's a broad question, but if you're trying to advise somebody as a passive investor in your side, right? What does that good deal look like for you? And like, what's kind of like, I guess safe is a wrong word, right? Because you can't guarantee anything. What does that look like if I'm a passive investor and right now you're looking for deals? What does that look like?
I mean, I think the very first thing you have to understand is there's risk involved in all real estate, right? I mean, we all know that, and we are signing up for that. We're aware of that. So I have to state that obviously up front again. The first thing though is mitigating risk. So everything that we do in these deals from a multifamily standpoint, it's set to mitigate risk. We're buying existing cash flowing properties. So we're not buying vacant properties where we got to go in and create all this value, right? We're buying a cash flowing property from day one. What we're going to do is find opportunities to add value. So if the property is making $100,000 in net operating income annually, I want to get that to $140,000 or $150,000, right? So we're making calculated adjustments to increase the value of the property. So everything we do is all about risk mitigation. It doesn't mean it's going to be perfect or flawless, but I'm trying to mitigate those risks, right? So you have to ask yourself, well, how can an investor lose their money? Andrew just gave you a perfect example, right? The loan comes due and we're not ready to either refinance or sell at that time. That could be one way we lose money. So that's one of the scenarios we have to work against. How do you force appreciation in a market where it could be going down in value? That's another big thing, right? If demand drops and we're doing all this work, but that value is not there, well, we're not going to make the money, right? So that's another way we can lose money on the deal. And those are really the two main ways. Everything else is kind of an offshoot of that. So the things we're looking for, what I would suggest to passive investor is understand the loan terms. Anyone doing a short-term deal, you don't control the exit and you're going to be forced to sell. So that's very concerning to me. The second thing is, what is the business plan? If it only works if you are investing a ton of capital into a deal and you're able to drive up the rents, I'm very concerned with that right now, because as we've talked about, we have unemployment going up. So if people don't have jobs, how are you going to try to drive rents if the demand's not there? Now, there's going to be some people who have jobs for sure. You're going to have people who had a single family house and maybe they got foreclosed on and they're going to have to move down to apartments. So there's going to be some inventory, but nonetheless, if your business plan only works if you're able to increase rents $200 per unit, I would be very concerned on that. So that's why you're buying something where you can cash flow day one, but maybe there's some immediate upside. Maybe there are other amenities that you can do. So for us, at least, it's understanding the different fees. If someone's paying for internet right now, well, why can't we get that internet money? Why can't we get the cable money? Why can't we charge for pet fees? Because people aren't going to kick their pets out. They're not going to move into an apartment and say, hey, I can't pay that $25 a month for the pet fee. So, Fido's going to have to go live with grandma. No, they'll pay the $25, right? So people pay for the things that they consider essential. So if you find a property where they're not charging pet fees, that may be one way you can get that $25 a month without necessarily increasing the rent. So there are things like that that you can do. You can, put in low flow water toilets, right? Where maybe you can decrease the water bills. You can cut down expenses, other things like that you can do. So for me, it's understanding what risk is from a macro level, and then finding ways to mitigate that risk throughout every aspect of the deal. And I say this is in general, we do this all the time, but especially right now, I would say make sure the deal works and it pencils as is. and you can operate it and still have a bit of an opportunity to increase the value, even if you didn't spend any more money, just from an operational standpoint. And then if you are going to invest in that property, if you're going to make some renovations, then that's great. But again, for us, I think that's the best way you can mitigate risk. If you were doing a single family flip, you kind of have to do the flip, right? And you have to sell it as quickly as you can. And you can't sit back and wait a year just because you don't like where the market is. You're going to lose money. In this case, we can do that. You know, if we buy a multifamily property and we don't like where the market is 2 years from now, 3 years from now, we can just hold it, take the cash flow another year, 2 more years, 3 more years, 4 more years. And that's why I say we're getting 10-year, 12-year loans on properties now, which we wouldn't have done before. But now we're looking at it saying, if I get a 10-year loan for 3.5% interest rate, let's do that. And then we'll sell it when it makes sense to sell. As long as it's a cash flowing property, we've got a lot of flexibility there.
Yeah. That's just a function of interest rates, though, because interest rates are low, but you know, in 10 years from now, they might not be as low, right? It might be back at 7% or whatever. So.
And that's another thing, right? So as a part of our business plan is like, if interest rates go up and we have an assumable loan, so let's say 4 years from now, interest rates shoot up to 5.5%.
More marketable.
Well, I've got a more marketable loan. Yeah.
So John, let me ask you this: if you're looking for a long-term loan, are you worried about the prepayment penalty? If you know, like obviously,
Yes.
If you have a long-term loan, you have. I mean, the exit's kind of hard, especially if you have prepayment.
Yes, it's a big driver. That's why I said a few months ago, we probably wouldn't have looked at a loan that long, right? So we've got deals where it's either a 5 or 7 year loan because those prepayments can get pretty expensive. But I think again,
then you've got defeasance in there too, if they're like really long, right? And
absolutely,
people don't even know what defeasance is. But
absolutely,
it's really expensive.
So
sounds like a dirty word.
Yeah, you've got to factor those things into it, right? So,
Yeah.
you know, understanding the terms on it, whether or not the loan is assumable, whether or not you can put a supplemental loan on top of that loan, are really important. But yeah, I mean, that's something that, again, there's risk in everything, right? And for me, I would rather, at this point, face paying a prepayment penalty than having my loan come due in the midst of chaos. So that's just the reality of it. If the market's that hot, again, we get to pick and choose when we sell. So if the market's hot enough where I could take a $500,000 or $1 million prepayment hit or pass it on to the buyer, then we'll do that. That's got to be factored into the deal. If not, then we just have to hold on to it a little bit longer.
Interesting times.
Yeah. I do kind of just want to add one last comment, and this was something that Tony hit on, is that there's just so much money out there, right? We were coming into this and everybody had a job, and there were so many. I mean, that's why it got so hard to flip houses and stuff, because there's too many guys bidding on them, right? There was just no inventory that made sense. So, you know, coming out of this, I think there's also going to be a lot of guys with a lot of money. So I don't think the prices are going to go down that much. It's certainly not going to be like 2008, 2009, but it might, but I sidelines. I really do. Or maybe not on the sidelines. It's just like available.
On that note, Andrew, I mean, you have, and this is for Tony too. And if I'm hugging the questions, you know, just yell at me.
No, go on.
On that note, right? You know, you said kind of like be patient and stuff like that, but there's a lot of caller here that's first-time investors, which they can probably get, you know, a long-term deal with fixed, really low interest rate, right?
Yeah, sure.
So, you know, if they're gonna house hack, what do you feel about that? Because my message to my clients, look, you know, like what John said, does it make sense, right? You know, is it if you're going there, are you are you living for free, right? That's the baseline for me, to be honest. And then after that, anything after that is like, you know, it's great, right? Because if they're going in Chicago renting $1,800 a month, then they buy a deal, putting down less than 10 grand when they're saving $1,800 a month, I think that's a deal, right? So I mean, what do you think about stuff like that? And this is for you, Andrew, and Tony too, because you guys are in that space relatively, like, pretty much, right? So I don't know, you know, what your thoughts about that, because there's callers here that looking for their first deal. So I mean, you know, I'm pretty sure hearing you guys to be patient, I don't know how they feel now.
Well, I'll tell you this, everything seems to be going at warp speed. The economy was doing great, lowest unemployment ever, to now the worst unemployment ever in a span of 60 days. So I think, you know, kind of going back to where I said there's a lot of money in the sidelines, number one. Number two, there's a real, no one knows what the right prices are. The sellers on single family homes, from what I've seen, prices are very strong.
Yeah.
And things are moving.
Yeah,
And,
my sister's a realtor. She's like, a lot of people who were selling their houses, a lot of those people who were selling their houses are like, no, we're going to stay put because of COVID. And that means there's less inventory.
There's
and
less
people got to
inventory,
move or want
rates
to
are
move.
low.
They're like, boom, we got to sell it. So they're selling at record prices.
And another thing too, just to give you some anecdotal evidence, I do think there's going to be a number of people moving out of these large cities to single family homes from apartments. My sister has lived in New York City for 20 years in an apartment in Manhattan.
Yeah.
And her company's letting her work from home for the next year until the end of 2021. Depending on what her husband's situation is, they're going to be looking to rent a house in the suburbs.
Yeah.
They're moving out of the city, and they're moving to the suburbs of Chicago. They're moving halfway across the country. So I think you're going to see a lot of that. I think there's going to be a lot of housing demand. We haven't had enough new construction housing for the last 10 years or more. So I don't know. I think now is probably as good a time as any. I don't know if prices are going to, you know, plummet in the single family or 2, 3, 4 flat market. But I don't think it's going to hurt you to wait another few months just to see where things go.
Yeah.
I agree. They call it de-densification. That's the term that they've been using for people coming out of the city going into the suburbs. Because, you know, you're right. Twitter, you can work from home forever now. Facebook's going to be the same way. Google, these are some of the biggest employers in America. So there's going to be a lot of people who are like, I mean, can you imagine living right now? You're like at 1212 South Michigan. You got to get to the 53rd floor and, you know, to your studio apartment, and you don't have any green space. And you're like, holy shit, I don't want to do this.
Well, that's the first mistake is buying that 1212 Michigan Avenue, the 50th floor.
Well, what about all these? Here's the other question that I have. What about all these like co-living situations and all these co-work? We work for living. I mean, these guys were like, it's all about the common elements. Nobody wants to touch a damn thing that everybody wants to touch, right? So that's gonna go. Real estate's gonna go through a little bit of a transformation here, and certainly commercial real estate, office space, and that sort of stuff. Obviously, this is not that, but this call's not about that. But at the same time, it's gonna be really strange going forward.
Does anybody have experience with those nursing homes or nursing home facilities? I don't know if you guys have.
I insure a bunch of senior housing facilities, but no nursing homes.
Well, if somebody has, I want to hear somebody's thoughts about that going forward. Because, you know, about a year ago, that's the new thing, right? You get $5,000 a bed.
Oh, yeah.
You know, now, I don't know.
Well, I think that's what Andrew was alluding to. There's this whole co-living arrangements where you have 3 or 4 bedroom apartments and you have sometimes 4 total strangers living together.
Right.
Is that what you're referring to, Andrew?
Yeah, sure. Yeah, absolutely. Yeah.
I think that's going to be a passing fad. That's not going to work out. And I know a number of guys, or I knew one guy was doing a number of deals. He was buying 3 flats and renting out the rooms to kind of a quasi-assisted living facility. I'll have to check in with him, see how he's doing. Can't imagine it's going to be a very good situation.
I'll tell you, just along those lines, think about student housing. You know, I just had a couple conversations with guys who are focused on student housing. They're like, well, think about it. School's going to open up in the fall. What parent wants to send their kid to go live in a quadplex with all these other kids on the same floor? So they're probably going to take them and say, listen, if you're going, we're going to get you an apartment off campus where you can have your own place. So a lot of those investors right now are starting to look at student housing off campus near some of these universities because they think demand's just going to skyrocket.
You know, I think that that's the case in that we are all talking as we're in the eye of the storm right now. But what's going to happen is there's every single drug company on earth right now is working on this vaccine. And once that happens, once they get this vaccine and they're going to fast track this whole damn thing, right? And then they're going to have so many doses available, maybe not right away, but like almost instantaneously, because every single company that is available to manufacture this stuff is going to do it, and they're going to do it for free. It's not going to be about the money. This is a public health, so they're like, we're doing it. So there's so much brain power. And I just heard Gottlieb on the CNBC there just before this call. He's like, yeah, we might have something by like January. So like, that's great. But like, once this happens and everybody's going to get inoculated with this vaccine, Americans have short memories,
Yes.
right? So it's not going to be exactly the same, but it's going to go back to a little bit of the same, right? So that kids aren't going to not go to college anymore, and there's not going to be no sports forever, so, and they're going to have this relatively quick. Now that granted, that's 7 months from now, and a lot happens in 7 months, and there could be structural damage to the economy by that time because of all these people that might not have jobs. But once everybody gets vaccinated, it's going to be, and they'll be way better prepared for the next thing that ever happens if there's another coronavirus part 2. So that's my take on the whole thing.
Guys, I want to kind of just do one last question. Does anybody have one last question before we wrap up? Because I want to be respectful of everybody's time here for our presenters. I just saw Cody Ray had one. What is it? Outlook on commercial office space. Hey, anybody want to take that one? Kind of wrap us up.
I'll take that one because I've recently the large deal I was mentioning earlier is in the Fulton Market area, and reading a couple months ago that Google was not going to do their second office building there, and maybe not having the density of employees at Twitter and so forth. I think it's going to ebb and flow. I think that it's the in thing right now to work from home. I think the productivity for the employees is going to go down. And it may be a shorter term lived concept and idea than we think. So I don't know, there's going to be some immediate downturn in office, retail, no question about it. But like Andrew said, people have a short memory. All you've got to do is go to Northwest Indiana and see the amount of people out and about on a daily basis.
Lake of the Ozarks. Anybody see the video of Lake of the Ozarks? It was like Corona never even happened.
Yeah, so here in Illinois, we're in quarantine nation, but I think things are going to go back to normal probably quicker than we think.
Pretty quick.
Awesome. Well, I want to thank everybody for being here today. This was a phenomenal panel. Panel guests, thank you guys so much.
Thank you, John. Thank you, everybody.
Yeah, I'm going to send out an email with their contact information. So if any of you, are interested in contacting them, you can reach out, have a conversation offline. And again, I want to thank everybody for being here. We will see how next month looks. Maybe we'll be back in person in Forest Park. Maybe we'll be Zooming. Maybe we'll be doing both. So anyway, thanks again, everybody, for coming.
Great. Thanks for having us.
Have a good night.
Thank you all.
Have a good night, everybody.
Excellent.
You're around.